Hello, welcome to this episode of Rich Insights. I'm Don Rich, Head of Investments for Esoterica Capital Markets. Today's topic is on the importance of asset allocation. The importance of asset allocation. That's how you mix your stocks and bonds, or you mix your investment dollars across the various asset classes. And again, the two main asset classes being stocks and bonds. Now, I recently read an article. This is going back a few months, and unfortunately I was unable to find it to share with you today. But the crux of the article was about keyword searches in investing. I believe the article was authored by the Nobel laureate Robert Shiller, but don't hold me to that. But anyway, the keyword searches in investing. Now, just a few months ago, the most popular searches had to do with gene mapping, artificial intelligence, 5G, and so forth, right? The sexy parts of the investment process. Now, the other neat thing about the article is it had a time series, right? We could see over time what were the most popular keyword searches. And, you know, just following the European debt crisis in 2011 and following the Great Recession in 2008, the most popular keyword searches were on asset allocation, risk management, the basic principles of investing, right? The meat and potatoes. Now, the reason for telling you about this today is I've got a chart that's going to blow your mind. All right, I've got a chart that's going to blow your mind. Let's take a look at it right now. All right, here we have three lines, right? Three different strategies, three different investment strategies. Each assumes you invest $100 on December 31st, 1999. All right, so call it the Jan 1, 2000. And you held that to March 31st, 2020. All right, and we just want to look at how we would have done had we pursued one investment strategy versus another versus the third. So the black line would be if we put all our investment dollars, if we had all our allocation in bonds, right? And the bond portfolio I'm using here is the Lehman aggregate or the Barclays Ag. All right, so that's the black line. The blue line then would be if we the results if we had our money invested in 100% of our money invested in the S&P 500 all the time for the last 20 plus years, right? And the brown line in the middle is a stock bond combination. All right, stock bond combination. It assumes that if we had 60% of our investment allocation in the S&P 500, right, in equities, and 40% in bonds, and again, the bonds are going to be the Lehman Ag, this would be your performance, right? This would be your performance. Now, what you notice immediately from this chart is for most of the last 20 years, the brown line is on top of the blue. For most of the last 20 years, the brown line's on top of the blue. Now, just stop and think about that. I'll take you back to the chart in a second. Just stop and think about it. Let that one sink in. We just went through the longest bull market in history. Equities did very, very well. And yet, that wasn't enough to overtake basic asset allocation. Basic investments, putting some of your money in stocks and putting some of your money in bonds. All right. Now, is 60-40 right for you? Again, that's a question you have to determine. It is based on your risk aversion, right? Your willingness to accept investment losses. But again, what you see is most of the time, the brown line has been on top of the blue. A stock bond portfolio has been beating an all equity portfolio. And of course, where we're at today, it's beating it quite handsomely after the pullback that we saw in February and March with the coronavirus. Now, surprisingly, even the all bond portfolio, right, the black line here, the all bond portfolio is once again beating equities. We haven't seen that since back in 2015. All right, but it is true again today. All right. Now, that would seem to be the point, right? That's the shock and awe. that asset allocation is very important. Over the long run, you win just about all the time with some mixture of stocks and bonds. But here is the kicker. Not only do you end up doing better, much less risk involved. All right, these gyrations, right? These gyrations are muted substantially when you hold stocks and bonds. Now, as I recall the numbers, to give you an example, at the end of March, the bond portfolio, the ag was up 3% on the year, right? That was as of March 31st, while equities were down 20 to 25%. All right, so you can see by mixing stocks and bonds, the drawdowns aren't nearly as severe. It makes it a lot easier to sleep. The first rule of investment, or the first rule for me in terms of building wealth, is first preserve the wealth you have. That's our message for today. All right, I'm Don Rich. You just experienced a rich insight. I hope you've enjoyed it. May your beer be colder than the company you keep. We'll talk again soon. Thank you.